I'm here with Morgan Flager of Silverton Partners here in Austin, Texas at the wonderful McCombs Executive Center. And Morgan has been in the venture capital space for a while. And in 2009, Morgan, venture capitalists invested approximately $17.7 billion in about 2,800 deals.
Yep.
And that was really the lowest level of dollars invested since 1997. What in venture capital has really changed over the years?
Yeah, so just to kind of direct the question of the amount of capital invested and kind of what's changed about that, or why is it lower than it has been in past years. I think what we observed was more of a knee-jerk reaction rather than it was kind of a fundamental change in the industry. And kind of what that reaction was is so the success in this business is based on exits, whether they be M&A or IPOs, and those are driven by valuations predominantly in the public markets. And those were pretty depressed. And then, especially on the early stage side, which is where I play in the industry, we depend on other funders to come in and support the company, as that company grows. And a lot of people were sitting on their hands with respect to their dollars and not wanting to invest them. And so, as an early stage guy, that's pretty scary. And so we certainly weren't the only one that kind of had that perspective. And so what I think you saw a lot in the venture capital community is people, they still have the money, they're still interested in doing deals, they were just scared more than anything else to kind of dip their toe in the water and make investments, and so that's why the funding level dropped. There are other changes that we can discuss, that I think will linger kind of past, just the leading indicator of the amount invested, but I think that's predominantly why you saw that drop.
So what does the horizon look like for the balance of 2010 and beyond?
Yeah, so my personal view is we're probably going to see it come back. Most of my colleagues in venture capital, their portfolio companies had very strong fourth quarters in 2009, and pretty strong, and it's a bit early still, but pretty strong Q1s as well in this year. And investment activity, just from my standpoint, seems to be picking up. And so you have portfolios companies doing well, the return of the stock market, and that's going to kind of, get people more interested in doing more investments. And so I wouldn't be surprised if by the end of the year, I don't know if we'll be back to where we were 2 or 3 years ago, but I would imagine we'll probably be pretty darn close.
And Morgan, what are really the key factors for small firms that are seeking investment dollars?
Yeah, so everyone tends to focus on market and team, and those things will always be important. But what I would say that's new is capital efficiency. And it's kind of, everyone says, well, venture capital has regressed a little bit back to the way it was 15 or 20 years ago when the industry was starting out. And back then, people weren't raising $20 million to start out with; they were raising far less and trying to do more with that. And so the industry, I think, the healthy firms are starting to do more of that, lighter weight deals, less capital invested, and there are technology reasons why that's the case as well. But, just from a risk management perspective, and advice I'd give entrepreneurs is, think about how you can do less with more. Think about how you can do innovative things with your business model and reduce the amount of capital that you need from a venture capitalist up front. And maybe you do end up raising more money down the road, but it's after you've kind of proven that a lot of the risk is out of the business versus coming with a crazy idea day one and asking for $10 million. I think those deals are harder to do now for a variety of reasons.
And Morgan, what is really the number one indicator of success whenever you're evaluating firms? Yeah,
so we kind of really look at I guess the 3 things that I mentioned all together. So capital efficiency is really important for us. One, because we think it's the right way to build businesses, but also because we have a smaller fund, and we like to play a big role in the company, and deals that require a bunch of capital just don't make sense for us. But so capital efficiency is one. A team is always kind of the critical piece of it, and we look for teams that have a lot of ambition to do great and amazing things, but also enough humility to kind of do what's required at every level to do it. And then a market opportunity where there's been some shift or it's rapidly growing such that some of the existing players in the market are having difficulty reacting to that shift. And so, and these are generalizations, but you kind of put those 3 together, and typically the deals we do have, good scores, and I guess in those 3 categories.
And what's really more important? Is it really the revenue traction, or is it the acceptance of the business model?
Yeah, so certainly some of the bigger wins have been based on market traction, and then the idea that we'll figure out the revenue later. And it's hard to argue that that isn't important. I think there are kind of a smaller subset of businesses where that's really a viable mechanism of success. Most of us who aren't the Facebooks and the Twitters and the YouTubes, have to focus on revenue sooner. And so for the predominance of companies, getting to those revenue points earlier is clearly important. And as an investor, deals that have that traction, on the revenue side and not just market acceptance, clearly, get our attention more often than not.
And the last question is, what role does risk management really play for these firms as you evaluate them and work with them?
Yeah, and so that kind of, I think, goes a bit back to the capital efficiency question, or answer, I should say, that I gave earlier. One way that we like to manage risk within our portfolio is, a lot of these companies, they don't need $5 or $10 million to prove out the viability of a business, or the fact that a consumer wants this or a business wants to procure a service. They may need $500,000 or $2 million. And so the idea of tranching capital in such that you can kind of prove out those various points, rather than kind of dumping a huge investment and hoping that at some point everyone figures it out. That's kind of how we look at it. From an entrepreneur's perspective, I don't know that it's that different. When you take an amount of capital, a large amount of capital, you're kind of stepping your foot on the accelerator. You're going to hire more people, you're going to be more aggressive with your marketing campaigns, and you're going to spend a lot of money. I mean, that's kind of the point of raising a lot of capital in most cases. And so if you're not on the right trajectory when you start to do that, you put yourself in a pretty precarious position. And so on the entrepreneur side, I think it's very similar. Think of ways where you can kind of come up with milestones in your business and raise the appropriate amount of capital to get to that milestone, and don't put yourself on a track where if you decide it's a smaller opportunity, or we don't want to invest as aggressively, you don't have to, because the amount of money you've raised hasn't kind of put you on that trajectory. So that's how I think about kind of risk management, and I think we encourage our entrepreneurs to think about it that way as well.
Awesome. Thank you, Morgan.
Yeah, thank you.